Hi, have you ever wondered what all those strange insurance terms and concepts were? Well, we're going to talk about some insurance definitions today. Insurance is like a lot of other industries. We have our own language. We have somewhat of a foreign language to other individuals. As you're learning insurance, it's really important to know some of these terms and definitions for test purposes and other reasons. So let's get into some of the important insurance topics and uh, insurance terms. Let's start with aleatory contract. Aleatory contract is a contract where uncertain events could happen and there is also an unequal transfer of value. Sounds like an insurance contract, doesn't it? Well, I always think about aleatory as walking down a path in Florida where there's an alligator up ahead and one of two things will happen. Either you'll get by scot-free and not have a problem and the alligator will go hungry, or the alligator will grab a hold of your leg and you'll have a very bad day. But there will not be an equal transfer of value between you and that alligator. One of you is going to get better off than the other. And that's the way insurance contracts work. First of all, it's an uncertain event. Whether or not you have a claim, whether or not the alligator is even there or grabs your leg. But it's an uncertain event, and there's an unequal transfer of value between you and the insurance company. So you could pay your premium for years and years and never have a claim. The insurance company gets a greater benefit then. Or you could just make one insurance payment on your homeowners and your house burns to the ground, your insurance company rebuilds your house. And so there is an unequal transfer of value. So again, aleatory contract, that is based on an uncertain event, and it provides for unequal transfer of value between the two parties, the insurance company and the insured. Let's move on to the next one, contract of adhesion. Contract of adhesion is really where you are stuck with your insurance contract, all right? I always look at it as, you got something on your hands and you're stuck with your insurance policy. And it's in this way that you're stuck with your insurance policy. First of all, the insurance company wrote the policy. They wrote the contract. They are not going to change it and change any of the language in there for your benefit. You're going to take it or leave it just the way it is. There is not going to be a way that you can make any modifications to it. So therefore, the insurance company wrote the contract. They have the stronger bargaining power, and therefore the insured has the weaker bargaining power because they can't change the contract. The insurance company wrote it. You either take it the way it is or you don't accept it at all. And so that is the contract of adhesion because you are stuck with the contract the way it is. Now, having said that, if there's any ambiguous language is language that is vague or unclear. So if there's any ambiguous language in the contract, then the courts will normally rule in favor of the insured when there's any ambiguous language that causes a conflict in the policy. So just know a contract of adhesion means the insured is going to have to keep the policy and contract the way it is. They're going to be stuck with it the way it is. It's a contract of adhesion, and they can't change any part of it but the insurance company wrote it. They have the stronger bargaining power. The insured has the weaker bargaining power, and the courts will usually rule in favor of the insured if there's any ambiguous language. And that is the contract of adhesion. Insurance is also an executory contract. Executory in this way, it just means that the contract is not fully executed until all parties have performed their duties. So when there's been a claim, it isn't going to be fully executed until the insured and the insurance company both perform the duties for that claim, and the claim gets paid and everybody is satisfied at the end. And that is when that's how it is an executory contract. It's not fully executed until all parties have performed their duties. Insurance is also a conditional contract. Simply means there is a condition section in the policy, and conditional contract means the company is going to pay claims based on those conditions that are in the policy. So insurance is also a conditional contract based on the conditions listed in the policy. Insurance is also a unilateral contract. Unilateral is another term. Unilateral means that it is one-sided. Now in this case, unilateral means the insurance company is going to be legally obligated to continue to keep coverage in force as long as the insured pays the premium. The insured, on the other hand, is not obligated to legally pay the premiums. Once they start a contract, they can stop paying at any time. Now, obviously, the insurance company is going to stop covering them if they stop paying the premiums. However, they're not legally obligated to pay the policy or pay the premiums. The insurance company, on the other hand, is legally obligated to keep that policy in force as long as the customer meets the requirements of the policy and they are also continuing to pay. But even if the insurance company wants to cancel, they can't do so without giving some notice. So they're legally obligated. It's a unilateral contract. They're going to be legally obligated to keep that policy in force. So therefore, if they see there's smoke coming from my house and they think now I'm a bad risk and they call me and say, hey, Steve, we're going to cancel your policy because you're a bad risk because your house is smoking, they can't do that. They've got to keep it in force as long as I keep paying the premiums. So that is a unilateral contract. And then one other is called contract of indemnification. Contract of indemnification, it simply means the insurance company is going to reimburse the insured back to where they were prior to the loss, back to the financial condition that the insured was in before the loss. No better and no worse. So contract of indemnification simply means the insurance company is going to get the customer back to their financial condition prior to the claim. If the customer receives more than what they had lost, if their financial condition improved after a claim, that would violate the principle of indemnity, another term in our industry. So the principle of indemnity simply says you are not, we're going to reimburse you, the insurance company is going to reimburse you back to the point of where you were prior to the loss, no better and no worse. Okay, so contract of indemnification simply means the insurance company, when there has been a claim, they will reimburse the insured back to the general financial condition of where they were prior to the loss, no better and no worse. That is the first part of our terms and definitions. Got a lot more terms and definitions to cover, but stick with us and we'll cover those in a future module.